Thank you very much, and welcome everyone to this year's Agronomists Conference. It's great to see so many of you here. I've been working for HCCA long enough to remember the first Agronomists Conference, and boy, how it's grown in terms of its popularity, in terms of its place within the industry calendar. Now, I've got 15 minutes to really talk to you about the economic rationale of rotations, something I could probably talk to you for about 3 hours, but I'm fairly sure I'll be booted off the stage by then. So I'm going to take you through a lot of the data, a lot of the detail quite quickly. You've got all the slides in your pack to take away, and at the end of your pack you'll find my contact details if you want to pick up any conversations after today. So hold on to your hats, just sort of a really headline view of my views of where we are in terms of rotations. In terms of an overview, why do we need to reconsider the economic rationale of rotations? Well, a number of issues to consider. Now, bearing in mind we're still early on through the day, I'm not going to get into the detail of the 3-crop rule. I think even the stiffest coffee isn't going to get you through that and help you survive the rest of the day. But I'm fairly sure you know that the headlines of what you need to know of how we're going to manage the 3-crop rule. I'm going to really get more into the economics and why that's making the rotation more important. Really talking about the power shift in the rotation. That's traditionally fueled by a drop in grain prices traditionally, and that's that driver and the weather driver of pushing, say, in a wet autumn acreage away from autumn to spring cropping are the traditional drivers. We've got some new ones coming in, especially when we consider the economics of oilseed rape. Is the risk worth the reward now with lower prices? And the inherent yield risk that's there anyway, but now we have the added benefit or the added challenge, I suppose, of the neonics as well. And now this year, we're continuing to see the impact of blackgrass and other pests as well. And that's really forcing us to, as you know, to rethink rotations. And cultural control is something that I remember learning about at university and thinking, oh, well, that's all well and good, but it wasn't really an economic rationale all those years ago. But now, of course, it is starting to take pride of place. But then we have to consider the rotation and how it's being segmented. How are we going to apply it to different farms and different businesses? Really, the first one that strikes to my mind is the owner-occupier versus the tenant farmer as well. How many tenant farmers are paying substantial rents can afford to let land up for a year's fallow, or indeed let it up for a year's cover crop as well. So we've got those drivers as there as well. But if we're going to extract the true benefit of adjusting and being flexible to a rotation, we actually have to adopt a consensus of having a flexible fixed cost base as well, labour and machinery and broader fixed costs. And I appreciate as agronomists that probably feels outside of your remit, but if farmers are going to really capitalise on shaping their rotations, flexing their rotations, the ability to flex that fixed cost base becomes really important. I'm not going to get into too much detail on that in terms of how are you going to make the most of those wider cultivation windows, wider harvest windows, and it particularly becomes apparent when we go through periods like this, when potentially we'll see consolidation, some farms getting larger. But can farms get larger but without actually investing in a greater harvest or planting capacity? And that's where we start to get into some interesting economics on the rotation. There isn't enough time to get into that today. What I'd like to do first is really just present you with some data. Now, a couple of caveats on this data. We're looking at gross margin data here, and we're looking at forecast gross margins ahead of planting, the pre-planting, and that's the key bit because that's what influences the farmers, or hopefully influences the farmer's decision. I've taken the data here from the latest agriculture and budgeting costing book for the 2015 harvest in the blue bars, and then gone back and compared that to our harvest where preceding that we had some pretty high prices. And so the economic incentives are very different between these two crop years. And what I've looked at, I've taken first feed wheat as sort of the standard and looked at a range of other crops within the rotation, essentially, and taking a percentage of the gross margin. And I've highlighted the bits I want to talk about. Let's just scan across here. Feed barley, I think the audience is divided, and I think the spectrum of performance on feed barley is getting wider, particularly on winter feed barley, because we've seen the advent of the high-yielding varieties and real professional producers of winter feed barley there. So let's just take that scope. The first major one is look at winter oilseed rape. Look at that big down arrow, look at that shift. Back in 2012, when we were making decisions then, we were looking at oilseed rape being, on a lot of farms, the most profitable crop. It had emerged, we saw big price increases, we were looking at some good yield growth, and actually oilseed rape was looking at a very strong performing crop. Now though, with lower prices, that has really reshaped how oilseed rape looks as a break crop. And it's forcing us to consider broader break crop activity, what else is available, back to that real traditional debate that we were used to having. On the other side of the equation, look at the winter beans. What oilseed rape has lost, field beans have gained. And I'm going to touch a little bit into my thoughts on what's happening and the risks and the opportunities that the pulse market provides us as well. Into the spring crops. The up arrow there on oats, we need to treat with a little caution. It's primarily driven by price and the oat price relationship with feed wheat. And whether that comes into fruition, whether that forecast in terms of that price relationship comes true, remains to be seen. But again, moving along spring oilseed rape, and again, what we lose in spring oilseed rape, look at that gain in beans. And that's where I want to move on to next, is really consider what's happening with spring beans, the underlying economic rationale for talking about spring beans and how they might focus. The graph here, again, up the left axis is the percentage or the gross margin that the field beans are producing as a percentage of that first feed wheat margin. And along the bottom there, really looking at the spring bean price relative to the feed wheat price. This is the real driver of the economics of deciding to grow spring beans, is that premium over feed wheat. And it's a little strange that we're linking bean prices and wheat prices. That mechanism isn't really a function of the market, it's a function of giving some transparency and giving farmers some decision-making ability in terms of where bean prices are. And you can see, as we increase the premium, and again, we're looking at two different price scenarios, wheat at 125, 175, so you can see the differential. But as we're increasing that premium, that gross margin becomes more and more competitive in the rotation. And that's really the first message, one of the key messages today. If we're going to accept the rationale that we need to see more pulses and more spring pulses at that in the rotation, we need to protect that rationale. And for that reason, we almost need to think about spring beans as a crop of milling wheat, as an anecdote. Yield, yes, we need to maximise that with any crop, but we need to protect the quality, and with the quality, we need to protect the premium, because the budgeted quality and the budgeted premium really are the underlying rationale for going for spring beans in the first place. So we need to my mind, think of spring beans as a crop of milling wheat in terms of how we protect it, how we market it, and how we preserve that quality. Because otherwise, we're then into the doldrums of really the feed protein market. And this is where sort of pulses can be caught between a rock and a hard place. At the bottom end of the market, the price needs to provide a premium to feed wheat to encourage actually anyone to grow the crop. But in terms of the actual demand, it has to be able to compete for demand and really find demand. Now, feed usage of pulses of beans in the UK has been going down in recent years, really because of the lack of supply. But if we're suddenly going to start to see more pulses coming in, then there may well be a need for that underlying feed demand to be re-stimulated. And what's going to do that? Well, it's going to be price competitiveness against the cost of imported soy meal, and it will have to be a discount because soy meal is essentially the go-to animal feed protein in terms of quality. That's enough on pulses. Let's rattle into barley and a lot more data here for you as well. Just to give you some orientation, the left-hand graph here is looking at scenarios where wheat is £125 a tonne. The right-hand graph is £175 a tonne. And let's first draw your attention to the diagonal green lines. On the right-hand chart, just look how steep that graph is. Along the bottom, we're looking at, say, what the yield loss of wheat is. In this case, we're attributing it to blackgrass, and at the y-axis, we're looking at the gross margin. So at higher prices, that yield loss is worth a lot more, and so is the incentive, the short-term incentive to get good control of blackgrass. Look into the left-hand when prices are lower, that actual yield loss is worth less. So the rationale to think about cultural control options actually becomes more viable. But for another reason as well. We can start to compare it to other crops. In this case, we're looking at feed spring barley. The two horizontal lines, to make it comparable, I've included it with straw and without straw as well. The audience will be divided over to what market is applicable there. But because essentially what the price does, at lower prices, the extra yield that wheat delivers over, say, spring barley is actually worth less. And so the threshold at which the justification to switch from moving from wheat to spring barley in terms of yield loss becomes less as well. So the thing becomes more sensitive and more justifiable behind cultural control. And I'm really excited about barley. I think barley, it's for ages it's been in the background of the other big global grains of wheat and maize. But barley is actually becoming really, really interesting. And the UK actually looks to be pretty competitive, and we look to becoming a competitive exporter of barley, and we actually seem to be becoming almost you could say, a world leader, a world producer, exporter. Let me just bring up some data here to show you what I mean. This graph's looking at global barley production and global barley stocks. And unlike what's happening in the broader grain market with wheat and maize, for instance, global production is actually struggling. It's not on that general upward trend that we see with wheat and maize. It's struggling. It's actually being displaced out of the global farmers' rotation. Over the last 20 years in Canada, for instance, the Canadian barley area has fallen by just over 2 million hectares. It just doesn't seem to be able to compete for acreage in Canada. It seems to be driven out by possibly soybeans, maize, canola, and it seems to be pushed out to the fringes. This represents a real opportunity, particularly for the UK, particularly because we have that yield advantage, and particularly it seems to be fighting for its place in the rotation. Now, in 2014, we produced 7 million tonnes of barley for the second consecutive year. We haven't done that since the late 1990s. Then we were relying on intervention to sort our barley situation out for us. For 2015, we could speculate that we should expect to see a crop of around 7 million tonnes. But the market seems to be sorting out. We seem to be a massively confident exporter, particularly outside of Europe, into North Africa, into Saudi Arabia. So we're not, unlike in the wheat market, where we're very much focused on getting our wheat, our first competitive destination is to get wheat into the European market. For barley, we actually seem to have a bit more of a say or a bit more competitiveness on the global market. And that's really, really interesting and really useful to bear in mind of where the UK currency is going. Euro continues to weaken, and exporting into the European market continues to be a challenge. Look at our relationship against sterling, against the dollar, and actually we look to be quite competitive. So non-EU exports actually could well provide us with an opportunity longer term. I appreciate I've rattled through that really, really quickly, so I'm just going to leave you with my take-home messages on this now. So really, lower grain prices, and of course those changing price relationships have really altered that rationale. But it's more than that this year. It's more than that going forward. It's cultural control. It's the need to think more longer term about the rotations, about giving us more sustainability. That will mean different things to different farmers, as I touched on at the beginning, owner-occupier versus tenant versus how long am I going to farm this land for, how far ahead am I able to can afford to invest in this land, or am I investing in it for somebody else's benefit, whoever takes on the land after me. One of the things I want you to take away is that we seem to be very good at sort of taking a rotation off the shelf and implementing it on the farm. And I think we need to kind of almost try and challenge that a little bit and be a little bit more responsive. I'm sure we're already seeing it in the industry as well, probably at an individual field level, and I guess if you think even from a precision farming point of view, even at the partial field level as well. But the key thing for me is to protect that underlying rationale for making that rotational decision. And I've used feed beans or human consumption spring beans as that example. Where we have to, the rationale for doing it is the rationale or the assumption of getting quality and the assumption of having a premium. That needs to be protected, otherwise we've lost the rationale. And one thing I would challenge slightly is, we hear it quite a lot, is I'm growing spring whatever because it grew well last year. 2014 was a very good year for spring crops. To an extent, so was 2013. So we just need to move away from, I'm growing this spring crop because it did well last year, because that's not rationale at all. That's just knee-jerking against what happened last year. I think more, and also my final point is that we need to have a better understanding of those indirect economic impacts, and that's more important to the pulses. How much is that nitrogen worth? How much is that nitrogen available? What does that extra organic matter mean to yields going forward? And if we can have that data, it can help us understand the economic rationale more and more. As I said at the beginning, there are my contact details. You've had a rapid race through that, and I hope you've taken something from that. Thank you.
Great, Jack.